ETFs from low risk to high risk. As with any investment, exchange-traded funds, ETFs, can exist on an extensive spectrum of risk, such that investors should not too quickly view all ETFs as a low-risk investment strategy. As we undertake a broad survey as to risk that exists in broad categories of exchange-traded funds, it will become clear that ETFs can carry significant investment risk, which in turn is tied to their profit potential. For that reason, it is important to understand how exchange-traded funds can cover the entire spectrum of investment risk, and that this needs to be appropriately factored into an investor's decision-making process, together with the research and analysis that they undertake. It's important to understand that all investments carry some level of risk, with the risk of an ETF being primarily determined by the underlying assets it holds, be they bonds, stocks, commodities, etc. Lower risk ETFs, short-term government bond ETFs. Short-term government bond ETFs invest in government-issued bonds like U.S. Treasuries with short maturities, typically less than 1 year, sometimes up to 3 years. As government bonds are backed by the full faith and credit of the issuing government, this makes the default risk very low, especially for developed countries. Short maturities means less sensitivity to interest rate fluctuations. Risks associated with short-term government bond ETFs include interest rate risk, though lower than longer-term bonds, inflation risk. Returns may not keep pace with rising prices. Short-term corporate bond ETFs, investment grade. Short-term corporate bond ETFs, investment grade, invest in debt issued by corporations with high credit ratings, such as BBB or Baa or higher, and short maturities. The lower risk of short-term corporate bond ETFs emanates from their investment grade rating having a lower likelihood of default. Short maturities reduce interest rate sensitivity. Risks associated with short-term corporate bond ETFs, investment grade, include credit risk, higher than government bonds as corporations can default, interest rate risk, liquidity risk for some bonds. Broad investment grade bond ETFs, aggregate bond ETFs. Broad investment grade bond ETFs or aggregate bond ETFs offer diversified exposure to a wide range of investment grade bonds, including government, corporate, and sometimes mortgage-backed securities across various maturities. The lower risk of broad investment grade bond ETFs or aggregate bond ETFs emanates from their diversification across many bonds and sectors that can mitigate the impact of any single default. Focus on investment grade reduces overall credit risk. Risks associated with broad investment grade bond ETFs and aggregate bond ETFs include interest rate risk, can be significant depending on average duration, credit risk, and inflation risk. Moderate risk ETFs, dividend ETFs focused on established companies. Dividend ETFs focused on established companies invest in stocks of companies with a history of paying dividends. Often these are large, stable companies. The moderate risk of dividend ETFs emanates from investing in companies that consistently pay dividends, that are often mature and financially sound. However, they are still equities and subject to market fluctuations. Risks associated with dividend ETFs include market risk, sector concentration risk. Some dividend ETFs may overweight certain sectors like utilities or financials. Individual stock risk. The value of the stocks can decline even if dividends continue. Large cap equity ETFs, such as the S&P 500, FTSE 100. Large cap equity ETFs track broad market indexes composed of large, well-established companies. The moderate risk of large cap equity ETFs emanates from investing in large cap stocks that are generally less volatile than smaller companies due to their established businesses and financial resources. Broad diversification helps. Risks associated with large cap equity ETFs include market risk, the entire stock market can decline, economic risk, individual company risk, though diluted in a broad index. Real estate ETFs and REIT ETFs. Real estate ETFs and REIT ETFs invest in real estate investment trusts, REITs, which own and operate income-producing real estate. The moderate risk of real estate ETFs emanates from offering diversification benefits and income potential. Real estate can sometimes act as an inflation hedge. Risks associated with real estate ETFs include sensitivity to interest rates, property market risk, economic downturns affecting rental income and property values, sector-specific risks, such as retail and office. Higher risk ETFs, mid-cap and small-cap equity ETFs. Mid-cap and small-cap equity ETFs invest in companies with medium or small market capitalizations. The higher risk of mid-cap and small-cap equity ETFs emanates from those smaller companies often having greater potential but also higher volatility, less financial stability, and higher failure rates than large cap companies. Risks associated with mid-cap and small-cap equity ETFs include higher market risk and volatility, liquidity risk, shares of smaller companies can be hard to trade, and business risk. International equity ETFs develop markets. International equity ETFs developed markets invest in stocks of companies in developed foreign countries. The higher risk of international equity ETFs, as opposed to domestic large cap, emanates from the introduction of currency risk, fluctuations in exchange rates, and geopolitical economic risks specific to those countries, in addition to general market risk. Risk associated with international equity ETFs from developed markets include market risk, currency risk, political economic risk of foreign countries. High-yield corporate bond ETFs, or junk bond ETFs. High-yield corporate bond ETFs, also known as junk bond ETFs, invest in bonds issued by companies with lower credit ratings, below BBB or BAA. The higher risk of high-yield corporate bond ETFs emanates from these bonds having a significantly higher risk of default, but offer higher potential yield as compensation. Risks associated with high-yield corporate bond ETFs include high credit default risk, interest rate risk, liquidity risk, economic sensitivity. Emerging market equity ETFs. Emerging market equity ETFs invest in stocks of companies in developing countries. The higher risk of emerging market equity ETFs emanates from emerging markets offering high growth potential, but also providing increased political instability, economic volatility, currency risk, and less regulated markets. Risks associated with emerging market equity ETFs include high market volatility, political and economic instability, currency risk, regulatory risk, liquidity risk. Sector ETFs, specific industries like technology, biotech, energy. Sector ETFs focus on stocks within a particular industry or sector, like technology, biotech, energy. The higher risk of sector ETFs emanates from a lack of diversification. The performance is heavily tied to the fortunes of that one sector, which can be very volatile. Risks associated with sector ETFs include high concentration risk, sector-specific volatility, regulatory changes affecting the sector. Commodity ETFs. Commodity ETFs invest in physical commodities like gold or oil or commodity futures contracts. The higher risk of commodity ETFs emanates from commodity prices having the potential to be extremely volatile, influenced by global supply and demand, geopolitical events, weather, and economic growth. ETFs investing in futures have additional risks that need to be strongly considered. Risks associated with commodity ETFs include high price volatility, geopolitical risk, supply-demand shocks, tracking errors for futures-based ETFs. Highest risk ETFs. Thematic ETFs. Thematic ETFs invest in companies related to specific, often niche investment themes like artificial intelligence, renewable energy, blockchain, or cannabis. The highest risk level of thematic ETFs emanates from these themes being speculative and prone to hype. The underlying companies may be newer, less established, and their long-term viability uncertain. They often have high concentration. Risks associated with thematic ETFs include very high concentration risk, speculative nature of themes, potential for bubbles, high volatility, business risk of underlying companies. Leveraged ETFs. Leveraged ETFs use financial derivatives and debt to amplify the returns or losses of an underlying index, typically on a daily basis, such as 2 times or 3 times. The highest risk level of leveraged ETFs emanates from their magnifying both gains and losses significantly. Due to daily resetting, their long-term performance can deviate significantly from the underlying index's performance, especially in volatile markets. This is known as compounding risk. Not intended for long-term buy and hold. Risks associated with leverage ETFs include extreme volatility, high potential for large losses, compounding risk decay, not suitable for most investors, especially for long-term holding. Inverse ETFs or short ETFs. Inverse ETFs aim to deliver the opposite return on an underlying index, also typically on a daily basis. The highest risk level of inverse ETFs is similar to leveraged ETFs, as they use derivatives and reset daily. While they can profit from market declines, markets tend to rise over the long term, making them risky long-term holds. Compounding risk is also a significant factor. Risks associated with inverse ETFs include highly volatile, significant loss potential if the market rises, compounding risk decay, not suitable for most investors, especially for long-term holding. Key factors determining ETF risk. Underlying assets, the primary driver. Equities are generally riskier than bonds, and within asset classes, small cap is riskier than large cap. High-yield bonds are riskier than government bonds. Diversification concentration. Broadly diversified ETFs are generally less risky than those concentrated in a specific sector, country, or theme. Leverage. Leveraged ETFs are significantly riskier due to the amplification of returns and losses. Geographic focus. Emerging markets carry higher risks than developed markets. Credit quality for bond ETFs. Lower credit ratings mean higher default risk. Interest rate sensitivity. Duration for bond ETFs. Longer duration bonds are more sensitive to interest rate changes. Liquidity of underlying assets. ETFs holding less liquid assets can have wider bid-ask spreads and be harder to trade, especially during market stress. Strategy complexity. ETFs employing complex strategies such as futures-based commodity ETFs, some alternative ETFs, can have unique risks that are harder to understand. Important considerations. Your risk tolerance. The safest ETF for one person may not be for another. Your own financial situation, investment goals, and time horizon are crucial. Time horizon. Some ETFs that are risky in the short term, like broad equity ETFs, may be appropriate for long-term growth-oriented investors. Conversely, even safer ETFs can lose money in the short term. Due diligence. Always read the ETF's prospectus and understand its investment strategy, holdings, and associated risks before investing. This ranking provides a general guide. Within each category, individual ETFs can also vary in their specific risk profiles. As with any investment, thorough research and understanding of the underlying holdings and associated risks are paramount. For more business, financial, and investment insights and information, subscribe to our channel and visit our website to learn about our financial and investment legal practice. Thank you.